Advanced Micro Devices Inc. is currently trading at $230.42, reflecting a $6.29 or 2.55% loss in today's intraday trading session. Now, the common expectation after a strong earnings report is a pop, a celebration of the company's execution. What most people are missing in this recent pullback, which started immediately following their stellar Q3 2025 results, is that the market is already looking past the near-perfect execution on existing products and is intensely focused on the execution risk of their next big thing. The reality is that the stock's failure to maintain momentum after beating on both the top and bottom lines, reporting record revenue of $9.25 billion and non-GAAP EPS of $1.20, both above analyst consensus, was a classic sell-the-news event driven by a critical reevaluation of its long-term AI scaling strategy, specifically in comparison to a certain dominant competitor. This is not about the performance of their EPYC CPUs or Ryzen chips today. It's about the perceived vulnerability in their end-to-end rack-scale AI solution for tomorrow. The immediate stock movement has been choppy, characterized by high trading volume, indicating a strong institutional divergence. While the Q3 report was undeniably strong, showing a 36% year-over-year revenue increase, with the data center segment being a massive driver, the institutional flow of funds has been mixed. We see large firms like T. Rowe Price significantly adding to their positions, a clear vote of confidence in the AI trajectory and the long-term targets of over $20 EPS and 35% operating margin. However, other massive institutional players have simultaneously been paring back their holdings or making dramatic position cuts. This split tells you that sophisticated investors are debating a very specific structural issue: the gap between AMD's hardware prowess and its software networking ecosystem. You see, the popular narrative says AMD is the clear number 2 in AI, poised to take significant market share from its chief competitor, NVIDIA. But the deeper, contrarian take, the one driving the recent hesitation, is that for AMD to truly scale into a data center infrastructure partner, not just a chip vendor, they must master the complex logistics of rack-scale AI deployments and, crucially, build out their own comprehensive networking backbone, something they currently lack and rely on external vendors for. This dependence, coupled with the continued relative immaturity of their ROCm software stack compared to CUDA, introduces a layer of execution risk that investors are struggling to price in. The recent surge in online investing via individual brokerage platforms like Fidelity and Robinhood has meant that retail investors often buy into the headline news of an earnings beat, driving a temporary spike, but the subsequent institutional selling on the nuanced guidance or execution risks is what pulls the stock back, creating this tension between expectation and reality. Daily trading swings have been volatile. For instance, the day after the earnings release, the stock pulled back nearly 4% despite the beat, with high volume. This was profit-taking, yes, but more significantly, it was a reaction to the management commentary surrounding increased operating expenses due to aggressive R&D and go-to-market investments, and a slight rise in inventory days outstanding. The market read the strong revenue guidance for Q4 projected at a midpoint of $9.6 billion, well above analyst estimates, but simultaneously priced in the cost of getting there. The market is basically saying, we believe you can grow, but we want to see margin stability as you spend heavily to compete. The recent news of AMD securing the contract to build the Alice Recoque supercomputer in France, an exascale system focusing on AI and HPC, is a massive validation point. It's not just a big order, it's a sovereign AI project demonstrating that governments and hyperscalers are willing to trust AMD's architecture for the most demanding workloads. This kind of high-profile win helps de-risk the narrative, but it needs to be replicated consistently across the commercial sector to truly close the confidence gap. The macro environment isn't helping stabilize sentiment either. The entire semiconductor sector, while still holding massive gains for the year, is highly sensitive to macroeconomic pressures, particularly interest rate fluctuations and geopolitical tensions affecting global supply chains. A general market risk-off sentiment, often triggered by Federal Reserve commentary or shifts in bond yields, can disproportionately impact high-growth, high-valuation stocks like AMD. Investors managing capital across platforms, whether through a Schwab Intelligent Portfolios strategy that mandates sector diversification or a hands-on interactive brokers trading platform approach, are watching the sector momentum closely. The sector's momentum has been slightly wobbly, even as the core demand for AI chips remains robust. This means that AMD's daily swings are not solely a reflection of company-specific news. They are amplified by the broader industry's jitters. The trading volumes remain elevated, a characteristic seen in stocks undergoing a major narrative shift, moving from a CPU challenger to an AI infrastructure competitor. To understand where Advanced Micro Devices Inc. stands today, you have to appreciate the transformation of its business model. For years, AMD was known primarily as a powerful but perpetually second-place vendor of CPUs and GPUs for the PC and gaming markets. Their business is fundamentally segmented into two parts: computing and graphics, which includes Ryzen processors and Radeon GPUs for PCs and gamers, and enterprise embedded and semi-custom, which includes EPYC server CPUs, Instinct AI accelerators, and custom chips for consoles like the PlayStation and Xbox. The latter, specifically the data center segment, is the engine of the current valuation. The strategic acquisition of Xilinx significantly broadened their expertise into adaptive computing and FPGAs, which is often an unsung hero in their data center solutions. Their past performance is a testament to an aggressive, well-executed turnaround under CEO Dr. Lisa Su, where they successfully chipped away at Intel's server dominance with their high-performance, cost-effective EPYC processors. This history of successfully taking market share is the foundation of the market's high expectation for their AI success. Now let's talk about the future outlook, which is where the tension truly lies. The expectation is that AMD's MI300X series and the upcoming MI450 and MI500 series accelerators will power a sustained high-growth phase. Their projection of greater than 80% average annual growth in their AI data center revenue over the next 3 to 5 years is an incredible aspiration, backed by key partnerships. The massive deal with OpenAI, which is structured to involve up to 6 gigawatts of AMD equipment and potential stock warrants, is the single biggest catalyst on the board. This deal validates AMD as a real alternative to their competitor, encouraging other hyperscalers like Oracle to also diversify their sourcing. However, the reality check comes from the execution timeline. The rack-scale MI450 Helios systems, optimized for large deployments, are not expected until the second half of 2026. This creates a multi-quarter gap where the market has to wait for tangible signs of this massive projected growth actually materializing. The company is essentially asking investors to trust the roadmap and the long-term financial targets that imply an exponential curve in data center growth. The key risks here are technical and commercial. On the technical side, the success of the MI series hinges on the continued rapid maturation of the Broadcom software ecosystem. The hardware can be best in class, but if the developer community and the pre-existing optimized models don't easily port over from the dominant platform, adoption will be slower and more painful. Commercially, while the OpenAI and Oracle deals are huge, AMD needs to diversify its major AI customers. If the next wave of deals doesn't materialize, the market will question the $1 trillion AI target addressable market the company has cited. The opportunity, conversely, is immense. If AMD successfully executes on their Helios rack-scale solution, providing a true turnkey, efficient AI platform, they will move beyond the perception of just selling chips and become a true systems player. This would significantly de-risk the stock and could lead to the multi-year compound annual growth rate in revenue they are forecasting. In summary, the story of Advanced Micro Devices Inc. stock is a classic high-stakes poker game, sitting right at that moment of tension where past proven execution meets massive unproven future potential. The expectation is simple. AI growth will lift all boats, and AMD is the primary challenger to the reigning champion. The reality is far more complex, focusing on software ecosystem parity, end-to-end networking solutions, and the challenging logistics of scaling rack-level deployments. The recent stock price action reflects this uncertainty, with a strong earnings beat failing to overcome institutional